Check this out. RBC and TD are both sounding the alarm. Our housing market is tanking. And it's not just because of interest rates or high prices. It's because we are drowning in national debt. Government debt, household debt, all of it. This isn't just a housing story anymore. It's a warning shot about Canada's entire financial system. Wait until the end to hear about what RBC said, and let's just put it this way, they didn't mince words. But first, please like, share, and subscribe. It helps grow our channel and makes this content more visible to others. Now, let's get into it. The housing market situation is ongoing, and they're expecting more weakness ahead. But they didn't stop there. They pointed to Canada's economy slowing faster than expected. And that housing, which was supposed to be our golden goose, is now weighing us down. Let me rephrase. Housing went from being Canada's economic engine to being our economic anchor. And we built everything around it. Our household wealth, our retirement plans, our tax revenue, even our GDP. Now, that whole structure is showing signs of cracking. RBC said our economy is now smaller than it was in 2019 when adjusted for inflation and immigration, and pretty much in the same place it was a decade ago. Hear the news saying we're the best economy in the G7? We should ask, what metrics are they using to come up with that? In their May 2025 special report, RBC flat out said activity has cooled dramatically in several major markets, with April home sales plunging 25% in Ontario alone, 33% in the GTA. They also added, this is one of the most intense corrections on record. And yet, so many are pretending this is just a pause. It's not. TD followed up with a brutal assessment too. They're warning of multi-year pain, not a blip, not a soft landing. They're basically saying, buckle up, Buttercup. We've propped ourselves up on cheap credit, supersized value increases for too long, and now the bill's due. In TD's March 2025 housing forecast, they said a double-digit quarterly decline in Canadian home sales and a mid-single-digit drop in Canadian average home prices materially marked down our 2025 annual average growth forecast. TD stated, we expect a 3.2% drop in average Canadian home prices nationally this year alone, with even deeper hits in regions like the GTA. For condos, get a load of this one. TD forecasts a 15 to 20% drop from the 2023 peak by the end of 2025. That's just not temporary, that's a reset. And here's where it gets dark. Our federal government still spending like it's 2020, like we're in stimulus mode. We've crossed 1.2 trillion in national debt. That's a trillion with a T. And our current prime minister wants to spend even more money? Make this make sense. But hey, let's just create more public sector jobs, keep people happy while we turn on the printing machine in full blast. You think homeowners are feeling the pain of rate hikes? Try being the government, billions in interest every year. And guess what? We're not paying that off. We're just rolling it over, kicking the can down the road, borrowing more to pay interest on what we already borrowed. And guess who's getting stuck with that bill? Yeah, you and me and our kids and their kids. It's a credit card cycle from hell. If we don't stop this in its tracks, where do you think this leads? Lower growth? Weaker currency? Obviously, this equals inflation. This is where the bank's risk assessment plans come into play. Now let's tie this back to housing, because when banks like RBC and TD issue these kinds of warnings, they're not just talking about home prices dropping. They're talking about risk. They're saying the fundamentals are broken. Canadians are maxed out. We have the highest household debt to income ratio in the entire G7. Let's expand on that. According to Statistics Canada, as of 2020, Canadian household owed approximately 185% of the disposable income, significantly higher than the G7 average of around 125%. I can tell you that the major chunk is your home. For comparison, UK is 151%, United States 102%, Italy 90%, StatsCan goes on further stating that Canada's economy is more vulnerable to financial shocks due to their reliance on the elevated levels of household borrowing compared to other advanced economies. Let me repeat that. We are the most indebted people in the wealthiest countries in the world. And it's not just mortgages, it's car loans, credit cards, lines of credit, and all of that gets more expensive overnight when rates shoot up. We're past the point where we can just say, we'll wait for the rates to drop. This isn't just about interest. It's about investor confidence. Like I always say, uncertainty is no good in any market. And that's dangerous because once people start doubting Canada's financial strength, our currency gets affected, our bond yields rise, and it becomes even harder to borrow. It's like a downward spiral. Meanwhile, our leaders are acting like none of this is happening, still promising new spending, still pretending like we don't have a debt issue, or for that matter, this historic debt hangover we're all living through. You know who's not pretending? The big banks. RBC and TD aren't just warning us, they're adjusting their risk models. So what does that mean? They're tightening credit, they're reducing exposure to residential mortgages. You know, the banks that make money from lending, well, they're pulling back. You know something's brewing when this happens. I heard of someone getting a home line of credit for $500,000, which sat in their account for a rainy day. Then one day they got this letter from their bank saying, sorry, we're reducing that amount we gave you and approved you over 2 years ago. And now we're reducing that 500,000 credit to 400,000. Have a good day. Wait, what? This is the first time I've heard banks scaling back like that. We built this house of cards knowingly. The government encouraged borrowing. The banks enabled it. And consumers, well, we bought into it because we were all told this is the only way. Buy real estate, leverage up. Prices will always go up. Remember that? When the government literally said, buy now, rates will stay low for a long time. Well, we all know what happened less than 2 years later. Now we got families renewing at double their previous mortgage rates. People taking out lines of credit to pay their bills. Seniors who spent 40 years paying into the system, barely making it between taxes, utilities, and food. That's how far gone this is. I always talk about balance. Economies are supposed to run like a well-oiled engine, but this one, it's sputtering, leaking, and no one's pulling over to check under the hood. I try to lay it all of today's real talk because we are here to be real. We don't do fluff. We talk about what really matters today. And right now, what matters is understanding that this market shift is not just about prices. It's about policy, debt, and structural risk, and what kind of country we want to be moving forward in. So here's what I'll leave you with. This moment right now is the wake-up call. The banks are waving red flags. The numbers don't lie. And the decisions we make in the next year, well, they'll reshape the next decade. If you made it this far, thank you so much. Seriously. These aren't easy conversations, but they're necessary. Like this video if you want more of the truth, not just feel-good market talk. Subscribe if you want to stay ahead of the headlines, and share this with someone who's tired about being left in the dark. Real talk, real issues, real people, and we'll see you in the next one. Thank you so much for watching.